Welcome to the Henry Show. Today I'm going to talk about what is a high earner who's not rich yet. So first off, what does rich mean? Rich means having so much money that it's spitting off interest and dividends and returns that you can live off forever for the rest of your life and not really worry. So what does that mean for you? Well, there's a pretty cool calculator here. How long will my money last? So for me, I think if I have $2.5 million and I can get an annual return of 8%, I can withdraw $10,000 a month basically for the rest of my life. So for me, having a liquid investing portfolio of $2.5 million would certainly be considered rich. And that's what this channel is about, getting to $2.5 million of investments. Now, in order to do this, you also have to have high income. This channel is for people who are making in the 24, 32, 35, or 37% tax bracket. That's over $200,000 married filing jointly. You simply can't save enough money these days and achieve all your life goals, buying a house, having vacations, friends, family, whatever it might be. You can't get those things and get $2.5 million unless you're a high earner. So high earning is important, saving is important, and investing is important to getting rich. Now, how do you invest as a Henry? That's something that this channel needs to cover. And I'm going to walk you through my journey as I try to reach $2.5 million. And I think the key is, first you got to understand some basics. So I'm going to compare a few portfolios here. And if your assets and your brokerage account doesn't look anything like this, then you really got to go read some books. You shouldn't be investing on your own if none of this makes sense to you. So if what I'm about to show you doesn't make sense, please stop investing and go hire a financial advisor to do it for you. So what's the classic setup? What's the tested and true? What's the thing if you could just recommend one thing that'll work for everybody and let it sit for the next 30 years until you retire? It's the 60-40 stock bond portfolio. And this is the combination of a diversified equity index fund and a bond fund. And in this case, I chose a very conservative bond fund, which is U.S. Long-term treasuries. And you can see it's going to have a meager 6.7% annualized return, but you're not going to have huge drawdowns. And, it's not going to have a lot of volatility. And that's because the bonds and the stocks kind of even each other out. And TLT is a really good hedge against, stock crashes. It's well known for being something that when people get scared of stocks, they flood into treasuries. So people are moving money back and forth versus just both going down at the same time most of the time. Now, the last few years have definitely been an exception, which is all about interest rates. And that's something I'll have to go into in a future video. Now, if you're a Henry, is this portfolio any good? Well, you're probably in your 30s. You're probably at the peak or 40s in the peak of your earning career. And these bonds, they're not going to be useful for you for another 10, 20 years potentially. And so they're also paying you regular interest, which you're going to pay a crap ton of taxes on. And that goes back to the federal tax brackets here. If you are like me, you're a high earner in California, you're paying potentially this year, I'm going to be in the 35% tax bracket, plus I have 10% state income tax, plus you have the net investment income tax. I'm pushing 50% on every bit of interest that I get from TLT. So for me, compared to, say, a retiree with no income, TLT is returning half as much. And that just means it's really not for me. So a lot of people make this choice to go 100% equities. And a lot of people like to also concentrate their risk into slightly more better, higher quality companies. So something really common these days would be to be 100% equities and be choosing the NASDAQ 100 as an index over the S&P 500. And for me, I really like this choice to use the NASDAQ 100 as your index of choice for your equity position over the S&P 500. And that's because I'm a software engineer myself. I understand tech, and I have a personal view that these big tech companies are going to continue to just dominate the world. So this is something that is a really great option. It's going to return you much, much more than your standard 60-40 portfolio. However, it's going to be subject to bigger volatility, bigger drawdowns, and so you have to have the guts for it. You can't bitch out. You can't sell this stuff when it goes down 40%. In 2022, I held on. I actually bought more, and by this year, I'm up on those positions now. So you can't sell when you get scared if you're going to hold the NASDAQ 100%. But there's a little more in here that we got to talk about. So if we look at QQQ, which is the way I like to buy the NASDAQ, and that's because this has great options on it. There are other cheaper expense ratio funds, but 0.2% is not bad, and I'm making a lot more than that with options. So I'm definitely a big QQQ fan, and that's the primary stock in my portfolio, or this primary asset, I should say. And yeah, you can see we have this huge drawdown. You can lose your shirt, but you have to hold on. Now, the other thing you'll notice is you're primarily making your return off of the appreciation of the price. So this is the all-time chart, and let's not forget 2001. You can definitely lose your shirt in this, but putting that aside, you're seeing that it's actually paying extremely small amounts of dividends. 0.62 is not a lot, basically nothing, but you're getting, again, going back to it, 17% a year. This is since January 2015, so not quite as long as I'll look back, and I'll go into that. But you're making 17% a year, and only 0.6 of it is taxable, right? Taxable is going to hurt you over the long term if you're a high earner and you're in a high tax bracket. So you have to watch out for that. Now, I also want to say, don't be scared to pay taxes, because paying taxes mean you made money. And a lot of people are so scared to make money because they're so scared to pay taxes. You want to be smart, but you don't want to be stupid about it. Now, again, NASDAQ is my core equity holding in my portfolio, but I'm going to go one layer deeper, and I'm going to talk about what I'm calling an uncorrelated growth portfolio. And what that means is that each asset here is something I chose because it's going to not move as much with each other, or not be as concentrated of a risk alongside each other. So it adds a layer of diversity that helps me sleep at night, right? And if I'm choosing 100% if I'm choosing to concentrate my risk into the NASDAQ 100, that's very tech focused, that's very software focused. Essentially, it's the virtual world eating us all up. I want to offset that. And so Brookfield Corporation is a very large multi-billion-dollar asset manager and holdings company that's really exclusively focused on real assets. And you'll see Brookfield has exactly the same properties that I like to look for in any stock. It's a growth stock, right? So again, very little dividend, very high price appreciation. And that means I can hold it for the long term and pay very little taxes. Now, I want to talk about these long-term capital gains taxes, because the way it works is if you're selling, if you're trading in and out, if you're making dividends, if you're making short-term trades or options or getting interest, all of these things are taxable in the year that you incur them. But for these type of stocks, if you just buy them and you hold them forever and you just never try never to sell them, then you can actually pay zero taxes for decades and watch this stuff go up and up and up. And then, right now, I very well could be in the 20% tax bracket this year for capital gains. But I'm not going to sell anything, so I'm not going to have to pay this. And when I have $2.5 million, again, going back to it, and I want to withdraw $10,000 each month, that's $120,000 a year. And you can pay 0% on up to $94,000 in gains. Remember, I put some money in at the beginning, so $94,000 in gains is probably me taking out $120,000, which is perfect. I can actually, a lot of people talk about putting things into retirement accounts like the Roth IRA and your 401k, but remember, if you just control your income in retirement and you're smart about it, and a lot of that comes from long-term capital gains, you can also pay 0% interest from investments in a regular brokerage account. So this is a really important concept to understand, when you are a Henry and you're trying to invest in a growth portfolio for the long term. You want to get most of your gains through capital gains that you can hold and not pay until after you stop being a high earner. Because remember, you're only rich while you have a high earning job. You have to have enough money in the bank to stop that job and still be rich. Now, the last thing I want to talk about in this portfolio is treasuries. Again, we talked a bit about, but also Bitcoin. And I'm going to make a future video about Bitcoin, and a lot of people have very polarized views on whether it's good or not, but you'll notice it looks a lot like this other chart. They're all up and to the right. And Bitcoin's been the best performing financial asset of all time. It's insane. So you really have to respect it at this point. It's becoming an ETF. It's becoming regulated. It's actually making its way into the professional investor class. And so this is definitely something to watch out for. And it's kind of timely as we've hit very close to a new all-time high today. So Bitcoin's on a run up 5% in one day. You'll love to see it. So going back to the portfolio, these are three, I'd say as uncorrelated as possible, but still all matching the pattern that I'm looking for of high growth and price appreciation with very little taxable return. And the last one is TLT. And this is a particular trade that I've made really due to the price action here and the rate action here in the last year or so. And we saw back at the end of 2023, this peak at about 5%, 5.3. And I thought to myself at that time, it's not going to go higher than that, right? Because if the government doesn't beat inflation and get this number down, then the U.S. government debt is essentially going to bankrupt the entire country. If you let interest rates get to 6, 7, 8, pretty quickly that's going to spiral out of control for the U.S. government, and dramatic action will have to be taken to, cut spending or raise taxes, which will then themselves collapse the economy. So, I didn't believe it. I wasn't a believer in 5%, and you can see here when it got closer, almost touching 5% again in the most recent correction, I just wasn't a believer also. So this time I said, I'm going to build this up. And it's also a sort of something we'll talk about in the future is timing it with your personal life. I'm very happy with the aggressive position that I've been building up in these other assets, and they're actually going to carry me through to that $2.5 million goal, even if I don't add a lot more. If I just hold what I have and get an average return, I'm going to make a significant progress just with the holdings I have. So I'm actually looking to de-risk it. And I thought a great way to do that was to introduce TLT and the treasury position. And you can see this portfolio in the last 10 years actually returned 24%. Now, had a higher drawdown, but not that much. If you're comfortable losing 32%, you're comfortable losing 36%. And in the long run, you're going to realize a significant greater return relative to this benchmark of the S&P 500 and relative to holding the NASDAQ 100%. So that's my video. This is what is a Henry. Hopefully I answered the question and taught you a little bit about what your investing strategy could look like.